Hi everyone, and welcome to the next lecture of the chapter, which is all about learning how to read financial statements. Now, we're going to use an example to walk through each of the statements to help give you a better understanding for what they are used for. Alright, so let's dive in. Let's say we are looking to invest in a retail clothing distributor. Before we invest in the company, we want to analyze their financial statements in order to get a better understanding of their company. It is important to remember that we mustn't solely look at the most recent statements, but we must compare these statements to the financial statements from previous years and to the statements of other companies that are in the same industry. Before I move on, let's first take a look at what the income statement looks like. Beginning at the top, the revenues line tells us what the total sales of the company were in the most recent fiscal year. The next line, the cost of goods sold, or COGS, tells us how much it costs to sell all of the items. In other words, it is the price at which we paid to obtain our inventory. The cost of goods sold value is subtracted from the revenue because it is an expense. Next, we look at all of the other expenses that our store has. This includes anything ranging from the utility bills to the insurance expenses, as well as the wages and salaries of the employees. And finally, this brings us to the net profit before income tax. This number can be positive or negative. A positive number means that the business is making money and will be further taxed. A negative amount means that the business lost money and will not be further taxed. So let's continue with our example of a clothing store to see what the income statement will look like. Let's say the store that we are looking to invest in sold $500,000 worth of clothing, and it cost the store $200,000 to buy all the clothes originally. In order to run the store, employees were paid a total of $100,000 and the utility bills for the store was $10,000. So now we have our revenue is $500,000 less COGS, $200,000 less expenses, which is broken down between the employees for $100,000 and for utilities at $10,000, which puts our before tax profit at $190,000. So let's assume that the store is taxed at a corporate tax rate of 25%, which means the taxes would be $47,500. Now, the bottom line of the income statement, i.e. profit, is $142,500. All right, so you may be thinking to yourself, wow, that's awesome. The store made $142,500. But what you should really be thinking is, so what? What does this number really tell me? And in order to understand what this means, we must look at past data for the company and compare the $142,500 of profit compared to past profits as well as profits of other companies in a similar industry to see how well this company is really doing. Let's begin by comparing the income statement of the store that we are looking to invest in with 4 other stores that sell similar products. All 4 stores have sales that are between $400,000 and $500,000. So, although these stores are selling more product than the store we're looking at investing in, there are still other factors that we must look at, like how long these stores have been in business and what their sales were like in their previous years. Let's just say that these 4 stores have been around for 7 to 10 years. Now, let's assume that the clothing store of interest that we want to invest in has only been around for 3 years. In the first year, they lost $10,000. In the second year, they made $60,000. And in the third year, they made $142,500. Now we have a bit of an explanation for why the store that we are looking to invest in hasn't made as much money as the other stores. It's just simply younger and still growing. In fact, by analyzing the income statement from the past 3 years, it is clear that the store we are looking into investing in has grown its sales at a significant rate. Growth is good because it tells us that if this trend continues, then the business will be worth more in the future than it is now, and so it may be worth investing in. Now, before we rush into investing in the store, there are still a few other statements that we need to look at. The next financial statement that we'll look at is the statement of changes in equity, which looks something like this. The first line is the sum of all the gains and losses from the years leading up to the most recent year. In our example, the store lost $10,000 in the first year and it made $60,000 in the second year, and therefore the first line on the statement will have a value of $50,000. The next line looks at shares that a company has sold. Again, a company sells shares in order to gain capital in exchange for a small amount of the company. The store that we are looking at sold $50,000 worth of shares, so this line will read $50,000. Next is the profit or loss for the most recent year, or for the current year, which was $142,500. The next line is how much was paid out in dividends. And a dividend is a certain amount of money that a company pays its shareholders as an incentive for people to invest. Now, let's assume that the store hasn't paid out any dividends, and so this line will read $0. Finally, everything is added up to give the final retained earnings. Okay, so the statement of changes in equity doesn't influence our decision completely in whether we want to invest in a company too much, but it is important to understand what each line means. The reason being is that it gives us a holistic view of how much money the company has made in its lifetime, which can help support its overall valuation. For example, if the company has made a lot of money in its lifetime, but one year didn't make quite as much of a profit because it was heavily investing in other areas, then this statement helps prove to us that this company probably has an idea of what it's doing, since it has demonstrated it knows how to make money in the long term. We still have 2 more financial statements to check out, but we have already covered quite a bit in this lecture, so we'll cover the other 2 financial statements and continue this example in the next lecture. So thanks so much for joining, and I can't wait to see you in the next lecture.